Thank you so much for joining us today. I'm Jenny Kassan, the president of the Crowdfunding Professional Association. I'm also an attorney working in the space of access to capital. And I'm really excited about our webinar today. We try to do webinars pretty much every month to really share the latest news about what's happening with investment crowdfunding and be as helpful as possible to the industry, trying to make this industry as successful as possible and help as many different entrepreneurs and investors as possible. So today, what we're going to be talking about is the possibility of getting tax credits for investing in a crowdfunding campaign. And we have some amazing experts here. And first, we're going to start with Brian Belley, who is the Vice President of Product at King's Crowd and also the Vice President of the Crowdfunding Professional Association and will be President in 2026. Um, so, uh, Brian has a lot of awesome data about the industry. So, Brian, why don't you share the latest updates on what's happening in the industry?
Awesome. Thank you for that intro, Jenny, and welcome to everyone joining us. I'm just going to take a quick 5 minutes today and give everyone a recap to kind of get us on the same page just in terms of where this regulated investment crowdfunding industry is, where we've come from, and then hopefully be able to set the stage for the really great discussion and the really great panel that we have planned here. So again, myself, Brian, I'm currently the Vice President of Product at King's Crowd. Now at King's Crowd, we help investors to find, research, and track all of their online investments who are investing in these companies online. And because of that, we track a lot of the data, which I'm going to be getting into. So very quick, just to set the stage, we'll talk about a little bit from the SEC's report in terms of small and emerging business capital needs. We'll then do a very quick revisit of just historical trends through 2024 for the regulated investment crowdfunding industry with both capital raised, investor trends, and also the potential of empowering some of these typically underserved communities, minorities, female founders, as well as impact investing. And lastly, before we get into the tax part of the discussion, the main part of today's webinar, I wanted to just provide two very quick charts to show that the markets are indeed driven by the regulations, by policy. We have precedent and data to show that when we make changes to the regulations, to different policies, do different things, that it actually results in different behaviors. So first, the need for small business capital. Now, this was taken from the 2023 SEC Office of the Advocate of Small Business Capital Formations report. So if you haven't taken a look at it, highly recommend you head over to sec.gov. But at a snapshot, what we're looking for small businesses, right? They are critical to the US economy. So as you can see here, 99.9% of all businesses in the US are small businesses. That's huge, as you could obviously tell, and also drive 43.5% of US GDP. Now, in terms of job creation and some of the great things, right, that this tax credit may be able to help incentivize, 63% of all new jobs come from small business. And over the past 3.5 years, so this report again came out in 2023, so roughly back to 2019, 1 in 5 adults was founding a new business, starting a new startup, a new business. That number is huge. If you just think about, 20%, 1 in 5 of every adult is now going through this process. However, when starting a new business, obviously, the access to capital is critical for those businesses to be able to grow to become some of these bigger businesses that they turn into. So when you're looking at some of the stats here, just to highlight a few, 78% of all the small business owners are concerned about their ability to access capital. Yet, over 50% of them are really only seeking capital of less than 50,000. As we'll show in the data, where the median amount raised under most of these campaigns tends to be in the 100 to 120,000. There's a really good opportunity here for investment crowdfunding to be able to help these small businesses launch and get off the ground. In addition, we went through some tough economic times in 2021, 2022, where 3.7x of startups were failing at a 3.7x higher rate compared to 2020, primarily due to lack of financing or investors. So as we will see and be setting the stage, it is crucial that we are able to attract the investors that are going to be investing in these companies online. Now, quickly revisiting the trends since basically Reg CF, Regulation Crowdfunding, launched in 2016, What we're looking at are nearly 9,000 raises across over 7,500 companies that have raised online. There's been over 4 billion raised across Reg CF and Reg A for operating companies. And there's been more than 3.6 million individual investments from people not only across the US, but Canada and other locations as well. So this is having a huge impact. If you compare this, for example, with the number of companies that have been IPOing or anything else, you can see that it's a really good source of access of capital for these entrepreneurs. And as we're also going to show, it's a access to capital for the types of entrepreneurs that may traditionally be underserved by venture capital or other traditional venture financing needs. Now, when we take a look at the Reg CF industry since 2018, so just take a look at the snapshot of the past 6 years, it had a huge spike in 2021 and then came down. But what this chart is showing is comparing it to venture capital, just to get an idea that the amount of growth that we experienced, even despite a slight pullback in the past few years, and we are now seeing indications that this number is turning around with more investors coming back, but still looking at roughly a 29% CAGR over that time frame. Anyone who can think or knows of anything compounding at 30% a year, that is a huge growth rate. And so it's showing that more and more entrepreneurs, founders, companies, small businesses are taking advantage of these regulations to get access to capital. Also, when we take a look at just the breakdown of Reg CF and Reg A, we see pretty similar trends, again, with a lot of that growth going into 21 and then a little bit of a pullback through 24. But if we take a look at the 2024 averages through last year, the average amount being raised per campaign was around 370,000, with a median around 120,000. Average check sizes tend to be in that $1,400 to $1,500 range, with between 250 to 300 investors per campaign, tend to be open for about 4 months. And then that was across 940 successful raises last year. Lastly, I'll just spend a little time to really show some of the data that is showing how funding minorities, women, impact, some of these underserved entrepreneurs is being successful through crowdfunding. So we take a look at the first 3 quarters of 2024, 30% of all the deals had at least one minority founder, 30% had at least one female founder, and 23% of those deals had a positive environmental social impact. So we're seeing the real potential here for things like investment crowdfunding to be able to be that alternative source of capital for these diverse businesses, and where they're being able to not only access the capital, but then grow as well through that. And just another breakdown of that, when you take a look at the participation of minority-owned businesses that are using investment crowdfunding, you can see the trend from 2020 to 2024 has been growing. So despite being 30% last year, that's moved up from roughly 23% in 2020, and it's been growing every year. So we're seeing, again, more and more access to capital for these entrepreneurs. Now, when we look at the number of, for example, Black founders, we can also kind of dig into the data a little bit deeper. We saw that 15% of all the deals in 23 to 24 were founded by at least one Black founder on the team. Compare this and contrast this with venture capital, where in 2023 and 24, it was roughly 3.5% of raises were being done with at least one Black founder, compared to the 14% here. And it's fewer than 1% of all venture capital dollars was going to a Black founded team. So this is just highlighting one of the many examples that we see in the data where these minorities and entrepreneurs and different diverse background founders are able to find success. All right, I will skim quickly over these, but this was really meant to show and quickly set up for the discussion around the tax discussion today, how we see when policy decisions, when regulation changes go into effect, when it's being driven, different investing behavior in the market. So this is a chart showing the Reg CF raises each year, and you can see there's a dip every single May. Now, anyone familiar with the industry will know that that is because the financial reporting requirements, right, are due 120 days after. So every April, many campaigns close and then have to get reopened after that. And this is just an example of, one of the things on the regulation side where we actually see it in the data. In addition, when we go back to the 2021 timeframe in March, when the regulation crowdfunding cap was raised from 1.07 million to 5 million, it was almost a step function change in terms of the types of issuers that were being attracted. So prior to that change with the 1 million cap, we were seeing a 7 million kind of median issuer in terms of valuation. It was a much more mature issuer after that, where it was attracting more capital. And so, really, what these charts are just saying is yes, the markets do respond to some of these changes, such as the tax credit we're going to be talking about today. All right, with that, I did fly through these, so we will be providing these slides for anyone who's interested, but I'm going to hand things back over to Jenny to introduce and go into the panel. Thank you, Jenny.
Thank you so much, Brian. And I will say there was a question, does this include raises for real estate projects? And the answer to that is this is for all Reg CF and Reg A raises, which does include some real estate projects. And so if folks do have any questions during the webinar, just go ahead and use the Q&A function. Thank you, Kate, for doing that. All right, so we're gonna jump into our panel. So first, I want to introduce our panelists. We have Marne Marotta of Arnold and Porter. She was a congressional staffer that worked on the original Jobs Act back in 2012, which is what made regulation crowdfunding legal and also made Reg A much more user-friendly. You used to only be able to raise 5 million under Reg A before the Jobs Act. And she's now a lobbyist who advises tech companies from startups to multinational companies on how to work with Congress and federal agencies to advance their legislative goals. And then we have Sherwood Neiss, also known as Woody, from Crowdfund Capital Advisors and many other initiatives. And Woody, of course, was very, very involved in the passage of the Jobs Act as well. So super excited to start this conversation. But before we jump in, I do want to quickly share some background on an initiative that we're working on. So Crowdfunding Professional Association is part of a larger coalition called the Coalition for Crowdfunding American Jobs and Prosperity. And this coalition is a large group of organizations that care about supporting small businesses with access to capital. And we are lobbying for a tax credit for folks who invest in a crowdfunding campaign. And so we do expect, as we're going to discuss, I just heard today on a webinar with the Angel Capital Association that, you know, the key piece of legislation that the president is really interested in getting passed this year is an amendment to the tax code at a minimum to ensure the continuation of what he did in the 2017 Tax Cuts and Jobs Act, but with a lot of potential new provisions as well. So it's a really good time to be talking about potential changes to the tax code. And what we support is an Internal Revenue Code amendment that allows a 50% credit against income tax up to $1,000 annually, or $2,000 for a married couple, per individual for an investment made on a regulation crowdfunding platform or under regulation crowdfunding. So that's what we're advocating for, and we will go ahead and share how you can get involved in this advocacy. We'll put some links in the chat. But as a starting point, I want to ask Marne to tell us a bit about you and your involvement with tax policy and what is likely to happen this year with tax reform, as far as you can tell. And why is this an opportune time to be proposing a tax credit?
Absolutely, and thank you so much for having me. It's a great discussion and it's a very timely one. As you mentioned in your intro, I worked on the original Jobs Act that included the crowdfunding provision, and since then have left the Hill and am working as a lobbyist, attorney lobbyist at Arnold and Porter, helping companies really navigate not just the policy network, but also to advance their policy goals. This really is an exciting year. The last time we had a tax bill was 2017. And because there are provisions in that tax bill that expire this year, it is one of the few times that Congress will have to do something, which means that we'll either have some kind of extenders bill or more likely have some kind of package that is bigger than just the extension of the tax provisions. The reason that that's exciting is that it's a time where you can go to your members of Congress or any member of Congress that you can connect with to advocate for something like this. And I know that Woody has some exciting information and stats to share on just what a positive impact this kind of tax credit could have. And so it really is a time to get out there and tell your story to see if you could get the provision included in this tax reform bill.
Sorry, gotta unmute. So, given that we are talking about a tax credit, and not everybody really knows how tax credits work, can you just say a bit more about like what exactly is a tax credit? If it did pass and I wanted to invest in a crowdfunding campaign, how would I take advantage of that? How would I like show it on my tax return? Would it take a lot of extra work? Would I have to pay more than $1,000 to my CPA to be able to take advantage of it? Tell us a little bit more about the nuts and bolts of tax credits.
No, of course, happy to do so. So the beauty of the tax credit that is being proposed is that it is simple. It's not going to be it's not going to be a lot of work to take advantage of. And it's pretty easy to understand. So the way a tax credit works is it lowers the amount of your tax bill dollar for dollar. So like, let's say you owe a $5,000 on your taxes in taxes at the end of the year. If you were to get $1,000 tax credit, your tax bill would be reduced by $1,000 and you would owe $4,000. And then the beauty of it too is that unlike a tax deduction, which reduces your taxable income, the value of the tax credit doesn't depend on what your tax rate is. So you're getting that dollar for dollar value. So it's an easy to apply one, and it's one that you can really see a tangible difference in.
Cool. And if, let's say, how sometimes we have a lot of deductions like removed from our paycheck, so maybe at the end of the year we don't owe any tax. So I assume that means it would just result in a tax refund in that case. We'd get a check back from the IRS.
That's correct.
Got it. Okay, cool. So, let's see. So Kate, we are talking about a federal tax credit. We're lobbying for a federal tax credit. Um, So, I do want to ask, since we have the policy expert on on tap right now, there's a question from Jonathan. The IRS has taken the position that the tax credit itself is taxed as ordinary income. Do you know if that would be the case? That
So the tax credit would not be taxed. Comes after you do your your tax calculation. You take the tax credit off after that, so it is not taxed.
Okay, cool. And then there's a question about the minimum investment to get the full credit. So the minimum investment to get the full credit would be $2,000 because it's a 50% credit of up to $1,000. And if you're a married couple, it would be $4,000. So hopefully that makes sense. And it wouldn't have to be all in one campaign. You could spread it out over multiple campaigns over the year. And of course, you could do it every year. All right. So let's move on to start talking to Woody. So Woody, you are well known for doing a lot of research on the stats of the industry and the impact on the economy of the industry, and also a lot of awareness about what's happening in multiple countries when it comes to investment crowdfunding. Could you share what you've concluded based on all that you've seen? What impact could a tax credit like this have? If we were to get this passed.
Yeah, by the way, great to be here. Great to see you all. Thank you for having me. At the end of the day, and Brian was alluding to this, these companies that raise capital hire people, they spend, and this money's poured back into the economy. So when we're thinking about ways in which we can encourage investment, right now we're just trying to get people to invest in these businesses. But if you've got these tax credits that are there, it sort of de-risks the investment and gives them incentive to put more capital in or to get in if they haven't gotten in before. So when we're looking at this from a global perspective, we want to see what examples exist globally where this has worked before, so that we can maybe replicate that. And if there's one thing I remember from working with Marne and being on the Hill is, where else has something like this worked? And show us the examples, explain how it worked there, and let's see how we can craft one that works for our own economy here. So the closest one that we have to comparable that we're trying to do here in the United States is what has happened in the UK with what's known as the Enterprise Investment Scheme, EIS. and the Seed Enterprise Investment Scheme. Now, these have been around for quite a while. $30 billion has flown into these two, and it's supported 33,000 startups since inception. So you can see that it's working there. Now, as Brian was telling you, when we've got 8,000 companies here that have benefited from this without having any of this in place, you can only imagine if we sort of put these in place, what we can do to get more companies in, which means more economic impact, which means more job creation, everything that Washington wants. So let me tell you a little bit about what EIS and SEIS are, so you can see how it sort of compares to what we're trying to achieve here in the United States. So EIS is supporting growth stage startups in the UK. SEIS is supporting early stage startups. So it's, the beginning ones, we're more on the SEIS, I would say, although we're shifting, as Brian was alluding to as well, to more advanced, established companies that are post-revenue. So this whole EIS and growth stage startup area works incredibly well for where this industry is headed. But for EIS, they were giving a 30% income tax relief on investments up to £1 million per year. There were no capital gains on profits if they held the investment for at least 3 years. There was loss relief. So if the company failed, investors can offset the losses against their income tax. And in 2022 and 2023 alone, 1.96, almost $2 billion was raised and put into 4,200 companies. So that's pretty impressive on its own. SEIS, like I said, supports your probably your pre-seed, your early stage type of companies. And in the UK, they were providing a 50% income tax relief on investments up to £200,000 per year. Again, no capital gains on profits after 3 years. There was a loss relief that's similar to EIS. And SEIS in 2022 and 2023 raised $157 million, funding 1,800 companies. So, it reduces the investor risk, it provides long-term holding incentive, and it just increases the capital. So now let's sort of take that sort of example that they have in the UK and say, how can we apply it to what's happening in the United States, or what kind of benefit would we see? And a lot, you have economists that do this on a regular basis. And one of their favorite ways of doing this is to compare economies based on size and population, and see, what kind of multiple we could have there. So if the US economy is 5 to 6 times larger than the UK, a similar tax incentive, we believe, could generate up to between $13 and $16 billion in new startup investment annually. So when you're looking at the fact that, it depends on how you look at these offerings. When we look at them, we look at the aggregate amount that's raised. So we think that, companies have raised through Reg CF and parallel offerings a little over $500,000, $500 million. You can see that type of impact just dramatically increases it because we'll have more people coming in. We think that there'll be about 20 times more capital flowing into early stage businesses with this type of tax credit that would be available. Other than that, I think the biggest impact would be job creation. If you just look at the UK multipliers there and apply it to the United States, we could actually go from to 39,000 or 64,000 new jobs per year. So it's quite substantial. Right now, I think all in all, when you look at the companies that have raised money through investment crowdfunding, that, by the way, the vast majority of them are still in business. We've done research that shows only 21.7% of Reg CF issuers have gone out of business. So these companies have long-term viability, they're raising capital, or they're using that to hire people. We estimate that there's about 441,000 jobs that have been created and supported because, a lot of these people on their Form Cs say that there's 0 employees. Well, someone's apparently running the company. They're just not maybe on payroll. You've got seasonal employees, you've got part-time employees, and then there's this community of people that support businesses. And that's where we get to that supporting feature around it. So you could see how this would just be quite a substantial benefit to the United States economy in terms of job creation if we do something like this. We also look at the economic impact that these companies have by looking at how much money they're spending and what they're doing with that money. And so if you look at a 3.5 times multiplier based on what's happened in the UK, we think that there could be a 45 to $56 billion annual boost to the US GDP. So this type of credit, it's, we're saying you can write off up to $1,000. So it doesn't, the cost benefit ratio proves that this type of thing would provide a lot of incentive, but have such a great outlier effect that would drive so much more into the US GDP, which is what our government and really what we all want as well. So again, they showed that these companies were twice as likely to survive beyond 5 years. Our data shows that they're surviving longer here. Again, if you've got capital, that means that your longevity is going to be there. So, I think it works all around. I love the proposal that the CFPA has come up with. And, I just think that it can work incredibly well. We have not had it here. When we were working on this initially in DC, we didn't want to actually, muddy the waters with a tax credit. So I think the time is right now because we've done a few things with this industry. One, we've proven that we're here and we're sticking around. Two, as Brian just showed everyone, it's growing at that compounded annual growth rate. And we're not going to stop, even though we've had ups and downs on a geopolitical and macroeconomic event. Three, the amount of fraud that's taken place in this industry is essentially de minimis, as far as I'm concerned. There have been a few enforcement actions, but when you compare it to what's happening in the Reg D space, it's as if there's nothing happening in Reg CF. And that's really because we have this entire structure as to how you have to do disclosures. Fraudsters don't like to tell you they're going to commit fraud. So there's easier ways to do it than within Reg CF. So I think the time's right. We've proven that this industry's here and sticking around. We've proven that we've been able to generate jobs. We've proven that it's been able to have an economic impact. Now we need to get it to the next level. And this is one of those great ways that we can do it in a way that provides incentive to investors, de-risks it for them as well, gets our government what they're looking for, which is economic impact and job creation, and get entrepreneurs what they need, which is capital.
Yes. Yes. And I will add, this isn't the topic of today's webinar, but the Crowdfunding Professional Association and a lot of our allies are advocating for some improvements outside of this tax credit to the law governing investment crowdfunding, which we can share a little bit more about that if folks have questions about that. So it would be a really nice combination to be able to both have a tax credit that would incentivize more people to get involved with investment crowdfunding and also change some of the problems that are currently making it a bit harder for folks to participate. So, Marnie, I have a question for you, and I don't know if you'll know the answer, but given that there's so many different players in the world of investing in private companies, do you think there could be any part of the industry that would push back on the proposed crowdfunding tax credit because they would feel like this could make crowdfunding more competitive than, maybe investing in venture capital or, doing private angel investing?
So from my experience, during tax reform years, everybody is out for their provision that they're trying to push, right? And so there certainly will be other people pushing other provisions. I don't see this as one that's going to rise to the level that will attract opposition. And because the time frame for getting this enacted is pretty short, as long as you're being diligent about your outreach and going to all of your members of Congress, I think you'll be in a good shape. Even if there is opposition, that's when you fall back to the benefits of the tax credit, right? The job creation, the small business, building of small businesses, innovation, all of that matters to members of Congress.
Awesome. So let's see. One thing is we've been talking to members of Congress about potential changes to investment crowdfunding law and also the tax credit. One thing that we are hearing is the excitement about the fact that this tax credit would really be beneficial to US companies in particular because you can only use regulation crowdfunding if you are a US based company. And there's also other countries are kind of catching on and realizing that crowdfunding, investment crowdfunding is a great tool. So, Woody, you shared about the UK, but could you share learnings from other countries, what they're doing with crowdfunding and how we might be maybe falling behind and how we might be able to talk to our legislators about the fact that we need to stay competitive with other countries when it comes to allowing people to invest in the businesses they want to invest in.
Sure. Yeah. I mean, just this morning, I saw that the Kingdom of Saudi Arabia has exceeded, it was $800 million last year in their investment crowdfunding space. I was blown away with that because we literally worked on their legislation with them to create that, what, maybe 5 years ago. So they're newer than we are, and they're doing better in terms of more capital last year than we did. But what they have done is a very comprehensive way of, we're not just going to create a regulation that will enable an industry, which is really what we did here. They made it holistic. They got the Saudi Arabian Monetary Authority. They got they're essentially their treasury, their banking, everyone on board on an educational and promotional awareness campaign. And it's something that we really don't have. Like, CFPA is great at educational resources, and more people need to come there and get them, because I think there's a lot there. But if we could have our, the SEC, if we could have Treasury, if we could have all of these organizations, the SBA, I mean, I have no idea why the SBA has not lifted this up and ran with it. Teaching entrepreneurs about what this is, how to use it, how you can benefit from it. As Brian was talking about, women and minorities have been some of the biggest beneficiaries from this. So we need to have more awareness that I've seen in a global level, at like a federal level, in countries taking place, that I think is missing here. I also think the media needs to get more engaged, but that's not necessarily something that is a government driven policy. But I guarantee you, if there was more awareness and the government were doing more in terms of education, the media would probably pick up on the stories of these entrepreneurs that are getting funded and the benefits that it's having in these communities all across the country. I mean, just look at, we had these wildfires that took place in California and devastated businesses there. Devastated everyone. But you've got all of these companies now that are going to need capital to get up and running again. We don't necessarily have to turn to Small Business Administration. The entire benefit of turning your customers into investors is you turn them into brand advocates. And I just got done writing a book called Investimers, and shameless plug there. But it's literally this entire concept of we are now at the evolution where we need to take another look at what we're trying to get from these investors, turn them into brand advocates, and then get them to be marketing agents, not only for the business in terms of bringing capital and customers in and future investors, but raising awareness. So I think, on a global scale, we're seeing more of that happening. I think we need to just do more of it here in the United States.
All right. Would either of you say that there could be downsides, negative effects that might not be immediately obvious if this does get adopted? Can you think of any possible downsides to a tax credit for investment crowdfunding? I'll start with Marnie.
I think the only downside is that you'd have, one of the downsides would be that you'd have a higher uptake of crowdfunding investment, and just with that, more potential for fraud, right? So right now, there's not a lot of fraud in the crowd CF space, but there could be the potential for that. I don't know if you see any others, Woody.
When it comes to all of these tax credits and, write-offs or deductions, I think it's just confusing for people, quite frankly. As you said, Jenny, you need a good CPA. a tax person that can help you with this. And so, I think it's awareness. You can put this in place, but you need to remind people that these tax credits are there and you should be using them. So, I know that there will be people that are opposed to it. Marnie, I remember when I walked into one of the meetings with her early on, and she had her head on the table, and she was just like, "Oh, the state regulators are here right before you." So, I know that people are there with their own reasons for why you shouldn't do something. But guys, we just need to pull together. I mean, this is a smart thing. It's the next stage, and it will benefit the United States economy and innovation and entrepreneurship, as Marnie was just saying, more so than we've ever seen.
Yeah.
And
Oh, go ahead, Marnie.
no, I was just going to say there was a question in the chat about the time frame for the tax bill. And so I just wanted to touch on that pretty quickly. And it noted that the Trump administration's moving pretty quickly on other fronts. So this is a bill that would have to go through Congress, and it would have to pass both houses, both the House and the Senate. And the mechanism through which they're going to do this tax bill is called reconciliation. And so this week, actually today, we saw the House release their budget blueprint, which is the first step to taking a step toward that bill. The Senate released theirs last week, and they're both kind of moving in parallel to try to pass their budget resolutions. We're still a long ways away from that tax bill actually being written and put together and being considered by Congress. So I'd say that the potential for the bill to move is toward the end of the year, but that is great for this organization because it gives you some time to actually reach out to your members in Congress and educate them on the need for it.
Awesome. Yeah, and we are going to share a little bit about how to express your support. And yeah, Marnie and Woody, if you get a chance to look in the Q&A, I've been answering them, so look at the answered ones and see if I missed anything if you get a chance. I just wanted to bring up one last thing, and then maybe we could open it up for questions. People have already been asking questions, but I think I can allow people to speak and ask questions if they want to jump on. But I went ahead and looked. I always think, whenever you're trying to advocate for something, go look and see what it says about that thing in Project 2025. So I went ahead and looked, and there, as far as I could tell, there wasn't a lot of mention of tax credits, except to say that generally there's a feeling among the authors of Project 2025 that there's like too many tax credits. There's so many, special interests that have managed to get tax credits. So, I think that could be a bit of a risk in terms of getting acceptance of this proposal. But on the other hand, we do also know that there is another part of Project 2025 talks quite a bit about the importance of increasing access to capital for small businesses. So any thoughts about, those two cross-cutting positions and how they might affect, what happens going forward?
Yeah, I mean, I think that's just, I don't know that that's a unique position to Project 2025. There are a lot of tax credits, there are a lot of tax deductions, and we use our tax system as a way to incentivize certain activities. And so this is not a unique situation. This credit certainly wouldn't stand out as something different from other credits.
Okay, great. Well, I'm going to go ahead and share a little bit more about our proposal. I'm going to put a link in the chat that shows what we've created to kind of be our talking piece that shows who is supporting this. I have to admit, I've hesitated to say what we're calling this piece of legislation because some people don't love it. But if you click on the link, you'll see what it's being called. And there's many reasons why that was decided to be called that. We're happy to hear your feedback on that if it's nice. So yeah, the link is in the chat for who you'll see who many of the organizations who have signed on are on that flyer, and some background of what we're trying to achieve. We also have a really useful tool, which is a folder of materials that you can use if you like this idea, this folder will give you a toolkit of how to lobby your congressperson. And as I said in one of the Q&A answers, we are currently looking for a sponsor. It's not always easy to get uh, a tax proposal sponsored because there's this thing called scoring. Actually, I don't know, Marne, if you know about that and might want to say a few words about scoring. I don't know much about it, but I know it's helpful if you can get it scored. So yeah, Marne, tell us about that process.
Sure. So in order to pass a bill, part of the consideration that Congress goes through is whether that bill will add to the deficit or not, and in what amount. And so bills get sent to either the Joint Economic Committee on Taxation or the Congressional Budget Office to get scored. The Joint Economic Committee on Taxation is the one that does tax credits. And so they would look at the provision and say, how much money would the Treasury, would the IRS forego if this becomes law? So how much would the uptake be for this kind of credit? That is the number that you get back, and they score it over a period of 10 years. And the reason why that's important is that Congress sets goals for bills to either be deficit neutral or use some budget gimmicks to get there. And so that having a score allows you to say, well, this is what it's going to cost in order to implement your provision. And then you kind of have to play that up against the benefits of it to show that it's worth investing.
Right. And our understanding is it's not essential to get it scored. It's just helpful.
That's true. I mean, before a bill can get considered, before a provision gets considered, it has to be scored. But if it's part of a tax reform package, the whole package has to be scored. And so one of the benefits is you don't need you don't need two members of Congress to introduce your provision, but as a standalone bill, they can just fold it into the tax reform package, which is a little bit easier than having to introduce it by itself.
Got it. All right. So if you have a congressperson that you think would be willing to be a champion of this, please let them know about it and connect them with our coalition. And I put some links in the chat. One is the kind of two-pager that talks about the initiative and the people who have signed on to it. Um, the toolkit, which is called Grassroots, which gives you the tools to go ahead and advocate for this with your congressional representatives. And then also, if you have an organization that would like to sign on as a supporter, I also put a link in the chat for that. Another thing is, as an organization, Crowdfunding Professional Association is doing a lot of advocacy at the federal level to try to take advantage of the fact that there is a friendly administration and Congress right now to making investment crowdfunding a little bit easier and more exciting for people to participate in. So the more members that we have as an organization, the more we will have a credible voice at that level of advocacy. So I also put a link in the chat for joining Crowdfunding Professional Association. There's lots of awesome benefits to joining. We are having a meeting in October in Washington that's really, really fun that you'll get a discount on. You can also join some of our members only events and committees. So I hope you'll consider joining us. It's very affordable. So let's see. So we're open to questions. If anyone wants to type in a question or, raise their hand and I can unmute you. Oh yeah, go ahead.
Jenny, so Arno had asked a question about returns to crowd investors. Let me just throw some data out there, just so everyone can understand the opportunity in that space as well. In terms of the data that we track, we think that there's about $14.7 billion in valuation growth that's sitting there in these companies that have done follow-on rounds of financing. So we think that's a conservative amount because not all companies have done a follow-on round and marked that valuation. But even within that 14.7, I know we saw 50-something companies that had a down round. So we're accounting for the growth that's taking place. So there is paper returns that are there that will equate to money coming back to investors when these companies do have exits. 2024 was just an abysmal year for mergers and acquisitions. So we didn't see much activity in that space. But one of the things that you can do too, when you've got access to SEC filings and all that stuff, is take a look at the S1 filings or the, what is it, the 424B4 filings. And essentially the S1 lets you know, lets the SEC know that you want to go public. The 424B4 one is the one that right before you go public, it's like the final numbers and all that stuff. So it's fascinating to look. If you, we imported all that data into our database, and you can see that there's 52 companies that have filed S1s with 85 filings in there. There were 33 of those that predated 2016, so they sort of don't count. But you can see that there's even public companies that are using Reg CF to raise capital. But I think what's really interesting is we see at least 15 companies that have completed the 424B4 filings. So there's public companies out there. So, that's always going to be a small percent of these companies that go through Reg CF that have that big liquidity event. I think the majority of these companies, as you see in the private capital markets in general, is they get acquired. It's, we try to keep our pulse on that acquisition. I know Brian does a great job on it as well. But a lot of the acquisitions are, not necessarily publicly disclosed, but these, there are returns happening to investors there. Again, by the way, if there were more education out there at the federal level talking about this, I think there would be more awareness as to the returns that are happening. And I think the media would be picking up on that, because who doesn't want to cover your average American that got rich by waiting 7 years after investing in a Reg CF offering?
Yeah, well, I just have to break in there and say, a lot of companies pay returns without doing an IPO or getting acquired. I'd say probably most. I specialize as an attorney and coach in helping entrepreneurs that really have no intention of going that route to raise money. And many of my clients raise money using regulation crowdfunding. And not all of them, some of you who are on here have invested in some of them. And as you know, not all of them are paying returns as they had hoped. However, some are. There are some big success stories. And the way they pay returns is not through an acquisition or an IPO, but through maybe like a quarterly loan payment on a revenue-based loan, or on using a dividend on equity. So there's many, and all of these things can be offered using investment crowdfunding. So there's really no one size fits all outcome, which does make it really hard to gather data. I mean, I have enough trouble just gathering the data on my own clients and like what's happened to them over time and whether they have been able to pay returns to their investors. So, but the important point there is, when you do invest using under regulation crowdfunding, just really look at what exactly you're investing in. Maybe you're investing in a deal where there's no intention to get acquired. However, there is the intention to pay some kind of quarterly or annual payment. So many ways that you can get paid as an investment crowdfunding investor. Any other comments that any of the panelists, or Brian also, if you want to add anything? There was a question, what sectors are receiving the most investment in investment crowdfunding? I think Brian could answer that.
Yeah, or Woody, feel free to jump in. I can pull up the chart. So I know from last year, if we're looking at 2024, a lot of the ones that tend to be big are like media, entertainment, and publishing. We've actually seen a lot with food and beverage companies that tend to leverage it. But then there's some higher tech companies as well. So, business software applications, some of the ones you would traditionally see in more traditional venture angel investing. Woody, feel free to hop in. I'm sure you have a few others I missed that you know.
No, I think the fascinating thing that I saw was last year was a really big pullback in the sort of public markets and private capital markets for healthcare, life sciences, biotech. We saw a huge uptick in that sector in Reg CF last year, both in the number of offerings and the capital that was committed to it. So, that just shows you, if you can't get capital one area, you can go somewhere else to get it. Brian and I both, have venture funds that we're working from. Brian, I don't know if you're seeing as many life science deals as we are, but it's fascinating how many of them are in front of us on, a weekly basis that we're looking at.
Especially great point. I think yes, the answer to what we were seeing as well. And I think people might have an assumption or, oh, crowdfunding, it's going to be smaller investors and things like biotech, pharma, those companies are really deep tech or takes a lot of investment. But to your point, we've seen lots of deals and lots of them find great success making raising online as well. So I think it's the whole gambit, whether you're, a small Main Street type mom pop shop all the way up to this high tech, deep tech, we're seeing success across the board. So
Vince is asking if we can learn any lessons from the Opportunity Zones program, which was also part of that 2017 tax bill. Can anyone think of any lessons or parallels?
And I unfortunately did not track how the Opportunity Zone credits were used, so I don't know that I can draw parallels there. Sorry, but I'm happy to look into it and let you know.
Yeah. I would argue that those are so different. They are so complicated to take advantage of, and it's so limited who can take advantage of Opportunity Zone credits. You have to have a capital gain. You have to wait 10 years before you exit. I actually tried to start an OZ fund, so I know. So I would say they're pretty darn different from what we're proposing. What we're proposing is so simple. It's just $1,000 credit. There's so many tax credits. I'm working on trying to get a historic tax credit for a building I'm working on right now, and I have to set up all these entities to make it work. And it's over 5 years, and someone mentioned in the chat the affordable housing tax credit or low income housing tax credit, the new markets tax credit. Those are all so complicated and unfortunately so costly to take advantage of, which is so frustrating. But this is a really simple credit. It's something you could claim on your tax form. I don't think you would probably even need a CPA to help you claim it. Like it would just be one of a box that you would check when you're filling out your online return. So, anyone want to chime in? Any of our attendees want to chime in? I'm hoping you can raise your hand or at least let me know in the chat if you'd like me to unmute you. Arno has a question for Brian. Who are the others who track exit and failures?
you're looking at them right here, Woody and team. I'm trying to think if there's anyone else besides us, but there's been some studies, but I think they leverage a lot of both of our data. So I'm not sure if there's many others in the industry really keeping tabs on it.
I know CB Insights does a bit. Again, it's we love what we do. Brian, I'm sure Brian geek out over the data nonstop. We need other people to geek out with us.
Yeah. Please look both ways before you cross the street. We need you. All right. Anyone else want to add anything? If not, we can give you back 5 minutes of your day. We will be sending out the recording, as well as the links that we shared. Thank you everyone for joining. And please do feel free to email me. I'll put my email address in the chat if you just want to talk about any of this stuff, whether from my perspective as the president of CFPA or as an attorney working with folks who are raising money using CFPA, using regulation crowdfunding, and also I've used it myself. Some of you on here have invested in ones that I've done. Thank you for being so patient with me. All right. Thank you, everyone. Have a good rest of your day. Bye.
Thank you. See you guys.